Dumb money is only dumb when it listens to the smart money. In fact, the amateur investor has numerous built-in advantages that, if exploited, should result in his or her outperforming the experts and also the market in general.
I think the ordinary investor has a huge advantage over the institutional investor, or the so-called smart money, and I think that this advantage has to do with your ability to think long term. Long-termism and thinking about the processes that over the long term will create value is, in my opinion, a huge advantage. Wall Street wants to see profits now. It wants to see margin expansions now. It wants clear-cut proof of return on investment when a company engages in capital expenditure cycles, and it wants to see it now. You as an investor should want your company to invest in building for the future, setting itself up to capture as much value as possible while delighting its customers over time. And you need to have the edge of thinking in decades while the rest of the market thinks in quarters. In this video, I will show you that the rest of the market thinks in quarters, and you thinking in decades will give you a huge structural advantage. As Peter Lynch said in his book One Up on Wall Street, the typical winner in the Lynch portfolio generally takes 3 to 10 years or more to play out. Mercado Libre is, in my opinion, a great example of this in action, as the company invests in its future, improving its fundamental positioning and its ability to capture long-term value and delight customers over time. Wall Street punishes it for it. And in this video, I will use Mercado Libre and their latest earnings report to show you how long-term thinking beats quarter-to-quarter impatience. So even after boasting 45% revenue growth and 90% growth in the Mercado Pago credit portfolio, with 9 items sold per unique active buyer, so an increasing amount of items sold per buyer, more users on their fintech platform, more total buyers on the Mercado Libre platform, we're seeing the stock price declining. So all these fundamentals are moving in the right direction, right? And this is based on Mercado Libre's playbook of investing into its own growth, of investing in order to capture most of the opportunity that it lays ahead of the company. But Wall Street punishes the company because of short-term pressure on margins. As the company says itself right here in their latest report, we are conscious that the early stage nature of these strategic investments puts pressure on our income from operations margin in the short term. We estimate that the combined impact of our strategic investments, which include the lower free shipping threshold in Brazil, CBT, 1P, and the credit card, was equivalent to 5 to 10 percentage points off operating margin in Q4 25. These investments are driving tremendous growth and helping us to strengthen our leadership position across our market. We're confident that as all of these initiatives scale, their profitability will mature while reinforcing our competitive advantages and deepening our relationships with users across the platform. So the company is just notorious for investing into its future, investing into where they see opportunity. So this is where thinking in decades comes into play. As the market is thinking in quarters, so the company's margins fell short this quarter, right? So the company's margins were low in this quarter, and the market is nervous because it wants margin expansions now. They say that right here we chose to invest upfront in ideas of the business with the greatest long-term opportunities. We exit the year with clear momentum and confidence in our ability to capture the many opportunities ahead. So the company is obviously prioritizing investing into its future. They'll continue doing these investments. In the past, we've seen them investing heavily into building logistics networks, building the Mercado Pago platform and infrastructure, giving out higher interest yields on money held on the platform. We're seeing these investments paying off big time, with the logistics network being able to absorb higher volumes of orders while delivering most of them within a day or two. So they say here that operating an efficient logistics network is another critical pillar of our value proposition and a major competitive advantage. The large majority of orders across the region, including Brazil, qualify for free and fast delivery, with nearly 75% of fast shipments delivered within 48 hours. Our network absorbed a 41% year-over-year increase in volume during the year, nearly 500 million additional shipments, while maintaining the high service levels that have built trust over time. So this is something that yields incredible user and purchaser happiness, right? Being able to get the products you buy in time. And their heavy investments into their logistics infrastructure really has made them able to improve customer happiness, being able to absorb a 41% year-over-year increase in shipment volume. being able to deliver 75% of these shipments within 48 hours. And also, we can see here that their investments into Mercado Pago has paid off big time as well. Their assets under management has grown from 2 billion to almost 90 billion over the past 3 years, while monthly active users more than doubled from approximately 35 million to 78 million people. And this has been unlocked by their investment flywheel into Mercado Pago. So them paying attractive yields on the platform, paying attractive yields on money held on the platform, right? And as we can see here, their total credit portfolio has now reached 12.5 billion, and over the past 3 years it has grown more than 4x. So this is a result of the company maniacally investing into its own growth in order to capture this value. We're seeing this investment also paying off in terms of credit quality, with its 15 to 90-day NPL having fallen more than 300 basis points over the same 3-year period to a historic low of 4.4%. So they are seeing massive opportunities and they're investing heavily. As we can see right here, the scale of the opportunity is massive. They say here that the opportunity we face is substantial. Less than 20% of Mexicans and only 40% of Argentinians have a credit card. Penetration is high in Brazil, but the gap in NPS versus traditional banks is as much as 30 percentage points, indicating that many consumers feel poorly served. So investing into the company and investing into Pago has led to massive growth in user base. So we saw the MAUs growing by twofold. We've seen the credit portfolio growing manyfold. We've seen assets under management growing manyfold. And this is all due to the investments that they're making into the company because of the massive opportunity that they're seeing. We're seeing the same thing with the free shipping threshold in Brazil. As they stated here in their Q3 report, e-commerce penetration has the potential to double over the coming years, which implies the e-commerce market more than doubling. Our ambition is always to grow ahead of the market. Offering more free shipping is a key pillar to our strategy to capture this long-term growth opportunity. Turning back to this and really addressing this, they say here that the impact on behavior is clear. Since June, new buyers in Brazil have purchased more items across a larger number of categories with higher retention than cohorts that joined prior to the lower free shipping threshold. The ratio of monthly to quarterly unique buyers has increased, while users purchasing 3 or more categories per month have shown the fastest acceleration in the pace of growth. So offering this free shipping really has enabled the company to capture much more of the market, getting more new buyers on the platform and increasing the amount of items sold per unique active buyer, right? And so obviously this is due to them investing in the free shipping threshold, which really does come from them investing into their logistics networks in the first place, right? But them offering this free shipping threshold, them investing into the company, has hit the margins in the short term. And Wall Street is cracking over this. Wall Street is sending the stock down 10 percentage points over this. So with the e-commerce market having the opportunity to more than double over the next coming years, with 20% of Mexicans having a credit card, 40% of Argentinians having a credit card, very low credit card penetration in Latin America, very low e-commerce penetration in Latin America. As they say here, Latin America offers one of the biggest e-commerce growth opportunities in the world. Penetration is roughly half the levels seen in the US, UK, and China, and we see no structural reason why the region should not reach similar levels. And expanding on this, they say that our leadership position has strengthened consistently over time as we have invested across logistics, assortment, user experience, and our broader ecosystem. By bringing more people online, we stimulate demand, which in turn attracts merchants seeking access to our 121 million unique active buyers. So this is not a company that's scared of the future. This is a company that's very optimistic about the future. They will continue doing these investments. Over the short term, their margins will be hit. And as we established in the first place, Wall Street wants to see margin expansions now. They want free cash flow now. And all these heavy investments has really led to their customer satisfaction reaching new highs, with a record net promoter scores across e-commerce and fintech in Brazil, Mexico, and Argentina. This underscores the importance and the effectiveness of our investments to capture structural growth opportunities across the region. So we're seeing the company and its investments paying off in a huge way. We're seeing that the company itself says that they're in this position because of the initiatives that they have had in terms of investments. As the potential for online shopping in Latin America remains huge, While a huge part of the population continues to be unbanked and without credit cards, the company is setting itself up for major upside. But Wall Street only hears continued investments. It sees margins declining due to these investments and chooses to punish the stock. And this really does just set me up for my main point of this video. The average holding duration of a stock is 5.5 months. So not even 2 quarters, 6 months is the average holding price for a stock. So just in general, how much value do you think you'll be able to capture over 6 months? So over the last 5 years, the Mercado Libre stock price is not by so much. 5 years ago, it was trading at $1,500, and today it's trading at around $1,700. But we've seen the company's revenue growing by so much. As we can see right here, this graph shows the company revenue development. So in Q1 2021, the company's revenue was $1.7 billion. In Q3 of 2025, the company's revenue was $7.4 billion. So over time, we've seen the company creating a lot more value, capturing much more value over time, right? But the stock price hasn't really changed. The stock price is the same today as it was 5 years ago. Going back over the last 10 years, we can see that the stock price has changed a lot, but the revenues and the value creation of the company has changed by a lot as well. So we're seeing that over time, the investments and this playbook that Mercado Libre is applying, investing into where it sees opportunities of growth, investing into e-commerce, investing into payments, investing into Pago, investing into its logistics network, investing into its advertising network, right? Investing into all these initiatives really does drive up revenues over the long term. So holding this company for 6 months does not set you up for success. But imagine if you've held it for 10 plus years, like Brian Stoffel. Imagine how much Brian Stoffel has been through in terms of short-term swings on the company. You, as an investor, holding this company for 6 months, you don't get to capture all of this value creation done by the company. Over the last 10 years, Mercado Libre's revenues are up by so much. 10 years ago, they had quarters where they boasted $200 million of revenue. Now they're boasting $7 billion in revenue. So we're seeing an exponential value creation based on these investments into their own networks, into their own business. By applying the same playbook, the investment flywheel that they've applied, they create immense value, and look at how much they've managed to grow from it. You set yourself up for a higher degree of success when you're on that journey with a company over the long term. When you own the company over the long term, you will partake in gaining from that value creation. But in the short term, you're left being a victim of short-term Wall Street pricing sentiments. Wall Street wants margin expansions now, it doesn't get it. It gets the same playbook that has driven up revenues by this degree for the company. They're doing the same thing, but the stock market punishes the company for doing so. So this is where you really have an edge as an investor. By applying the playbook that brought the company to where it is, creating massive value in Latin America and capturing a lot of it, when you own companies over the long term, you gain from that value creation over time. Going back to that good old Peter Lynch quote, the typical winner in the Lynch portfolio generally takes 3 to 10 years or more to play out. So as the market and Wall Street wants to see profits now, margin expansions now, you have the edge of waiting it out. You can see how the company applies the processes that have driven up value over the long term and partake in that value creation. I appreciate your time. Thank you for watching, and bye.